361 Firm and Alumni Connecting co-host Public Equities Deep Dive, May 20, 2020. Please refer to important disclosures in the materials.
Got everyone. I'm gonna turn it over to Joe Zaro. This is part of his brainchild of doing this. I just wanted to at least point out that Thursday next week, we have a focus on restarts, and we're going to have actually some interesting people, 4 or 5 CEOs from Ohio companies, as well as some Asian, European companies. And you'll hear more about that later. And we have, sorry, I moved my scroll too quickly. And then we have other events coming up. You'll see, we did some past events on sports and media. We're going to be splitting those off. We have real estate is really the future of work and travel on the June 4th. So I think and if you haven't gone, you can go to our page that gives the synopses, and we're putting yesterday's we're putting into video, so we're finally getting around to putting these podcasts out. So that'll be good. And then we're, as you know, in parallel, we're launching these alumni connecting type events, and that next Thursday we'll have there's probably 5 different schools will be on there. So Joe, I'm going to hand it over to you.
Well, thanks, Mark. And hey, everybody, glad to see everyone's doing well. We've been doing these kind of more webcast style events now since COVID kind of got kicked off. And obviously there's a lot going on in the world, and the stock market's really reflecting that lately. And so every time we have one of these kind of discussions about public equities, it tends to, get cut short. And so we thought it would be really interesting and helpful for our network to kind of just allow that conversation to run and go a little bit deeper in this kind of deeper dive. So with that, we kind of thought it'd be valuable to bring together a panel of 6 institutional investors to kind of share their insights of how they're positioning their portfolios, and how they're just thinking about markets, and specifically for this conversation, how they're utilizing concentration right now and why that's a valuable tool in these sort of markets. And how they're using that to generate alpha and differentiated returns. And so on the panel, we've got Stephen Burke from ARS. He's a managing partner there. It's an institutional equity manager. They've got about 1.2 billion in assets, and they've been in business for nearly 50 years. We've got Eric Lindberg, the CIO of the Knowlton Foundation. We're also joined by Eric Anderson of Mill Trust, an emerging market specialist with about 600 million in assets. Andrew Randak of Fieldpoint Private, and Sam Sheinin, a managing director who's covering a concentrated equity portfolio of the single family office of Thomas H. Lee Capital. And we're also joined, I believe, by Nargis Zamani, a multifamily office here in the US. So with that, I'll kind of want to hand it over to Stephen to kind of give us a bit of a background and overview of, hey, what's going on in the macro environment. And then we'd like to kind of just keep it a little bit more free flowing in a way, but we'll kind of help to guide the ship as necessary. And, participants, if you've got questions, there's a chat feature on the Zoom, which you can kind of log things in there until we're ready to kind of go into a Q&A. But, let's try to allow the panelists to kind of to go forward. So Stephen, why don't you kind of kick us off?
Thanks, Joe. I worked at $2 trillion asset managers, and one of the things that I found fascinating at both places is how few high conviction managers there were inside the shops. And what I realized throughout the years is that high conviction management requires it to be in your DNA to actually want to be away from where everyone else is and be in that uncomfortable position. So I just want to share with you a couple of thoughts on the market. I saw this statistic about a couple weeks ago. So the 5 largest companies in the S&P, we all know, they have a combined market cap now of about 5.17 trillion and a weight of about 20% of the index. But if you think about what's that equivalent to in the S&P, if you can move to the next slide, that market cap weighting is equivalent to, Mark, could you advance? Is equivalent to the bottom 350 names in the S&P 500. So you're looking at a combined market cap of 5.17 to 5.19. What's interesting, though, we dug a little deeper and looked at what the free cash flow per share was for the S&P. And I looked at this yesterday, and for the S&P, it was roughly $147 per share. When I ran it for the 5 largest companies in the S&P, it's $104 per share combined. So when you think about the weighting of the S&P of the top 5 names and the contribution to free cash flow per share of the total S&P, they're big names in weight and they're big names in the contribution. But this is roughly 70% of the free cash flow per share of the S&P is in these 5 companies. So when you want to know why people should be thinking about high conviction investing, in our view, that's part of the case right there. The hard part, though, of being a high conviction investor is you are either very fortunate to be in step with the market or very in the unfortunate position of being away. And that's why it's got to be in your DNA to be comfortable and confident to be so far away from what everyone else is doing. And, you know, the advent of indexing really exposed how many closet indexers there were in the alleged active management space. For our firm, we've been this way since our start, and it starts with, for us, thinking about the macro environment and bring it down to what are the most investable secular themes, and then from those secular themes, executing on it. So if we can go to the next slide, and for those who've been on the call regularly, you've seen our big themes are around a few key areas. Actually, we jumped too far, but that's okay. The themes that we've been focused on are the, you know, tech around 5G, the cloud, and semiconductor area. We think of tech more as a less of a sector and more as the businesses that are embracing technology to bring down their costs. We've had healthcare as a pretty significant weight for some time and have increased that, obviously, with the virus. And then in the industrial and materials area, that's been primarily defense, not the traditional industrial area. But the other thing is we don't own right now 6 of the 11 S&P sectors we don't have any exposure to. So we're a very different type of manager. And we've seen a lot of studies that say, you know, what's the right level of money to be high conviction or not high conviction. And a lot of people use 30 names or less, and that's what we do in our flagship strategy. And this just gives you a representative position of our all cap strategy, which is our flagship. We have about 45% of our firm's assets are in this strategy. And what you can see is how high conviction it is with the tech exposure, communications, and, you know, we're one sector now we're much more combined. But the other thing is you got to get after it, not just on sectors, but are you putting the right weightings to the right names? And that's a big part of the challenge here. And when you're balancing off an all cap strategy of going up and down the capitalization structure, weightings and liquidity come into play there too. So we've been very comfortable being away from the market and using secular themes. So by taking a longer term view, it allows us to stay with themes even in those uncomfortable periods where you have underperformance. But we have a GIPS track record going back to 93 on this that has had some very healthy performance, and as has our 1, 3, and 5 year numbers. So there are times when it's really uncomfortable to be high conviction, and you just have to be ready for that, and we've been. But you know, the themes I've talked about throughout are the same themes we're employing, and you can see them in the portfolio here. So with that, Joe, I'll turn it back to you.
Thanks, Stephen. Why don't we just kind of go through the panelists, and maybe Eric Anderson, let's just take a minute each to kind of just introduce yourselves, your background and your firm, and then we can kind of start getting into specific kind of questions. But why don't we just go through Eric, and then maybe Andrew, Sam, Nargis, and then Eric Lingberg.
Okay. Yeah, can you hear me? Good, I'm off mute. Yes, good afternoon. Yeah, so Mill Trust is a London and Singapore-based asset management firm. We provide a range of institutional solutions across sort of 4 key areas: global EM, agricultural farmland, science, technology, and innovation, and sustainable impact investments. Really, the original focus of the firm has been on EM, and we've been doing it as a firm for over 10 years now. Flagship product is our global EM fund. And it really, you know, the aim, unsurprisingly, is to give investors exposure to the EM story, give exposure to companies that are leveraged to the key domestic themes. It's a bottom-up, concentrated, long-only strategy. But what's unique about it is our approach. Now, we have a multi-specialist approach, and this really feeds in well with the conviction idea here. is we identify locally based specialist investment teams in each of these are third-party local asset managers in each of the key regions of our universe. So this is China, India, Southeast Asia, Russia, etc. They have the boots on the ground, they have the access, the penetration, the stuff that you need to really have conviction in these companies. And each specialist team manages their country and portfolio on our platform. So we have sleeves or buckets, if you will, where we appoint these teams to manage. And from my side as the global PM, I then allocate across these different accounts depending on our asset allocation view. And we'll tilt, depending on where the headwinds are and the tailwinds are. We'll do that on a quarterly basis. So that's our approach. And we feel that in order to really get a high conviction EM strategy, that is the way to do it. So that's Miltrust in a nutshell.
Cool, thank you. Andrew Randak, do you want to go next?
Sure. Good morning. Thank you for inviting me to participate. I'm with Fieldpoint Private. We are essentially a multi-family office bank broker dealer RIA, all wrapped into one. We're headquartered in Greenwich. I used to work out of the Park Avenue office, but now I'm working out of the Park Slope office. So it's very different here nowadays. We are not a security selector, we're a manager selector. So we work with families to define investment mandates. Basically, my perspective on a lot of this is asset liability matching. What is your liability in the future? That can take any form. It can take the form of my daughter's tuition or a house in Palm Beach in the future. And then we design an asset allocation approach, which then drills down into specialty boutique managers. We have a manager platform of about 60 different managers and about 80 different strategies. And the idea is that we have the latitude, depending on the market conditions, to be able to go to high conviction, which is what we're doing right now, high concentration, high conviction managers when return dispersions are broad and offer a lot of investment opportunities, or like we saw a few years ago with QE and a lot of the increased liquidity, we tended to shift more towards beta exposures, where the return on that incremental dollar of asset management was higher. But in general, when we choose managers, we want high conviction, concentrated managers. So when we're in the active management space, one of the things that we try that is a turnoff for us are managers who get too deep into things like, attributions and contributions across segments and sectors and geographies. What turns us on are managers who start talking about return on invested capital in different business units within a company. We want corporate expertise. We want them to have high conviction about the companies they're buying, not about necessarily the sectors they're buying. And that's very important for us. And we take that same approach both on the public equity and on the public debt side, where we're more active in corporate credit than anything else. So. And we advise families both in the United States and what I do mostly is Europe and South America.
Great, thanks, Andrew. Sam?
Hi, Sam Shinen. Thank you for having me. I work in the family office of Thomas H. Lee, and within the family office, we're about 85 to 90% public equities, with the rest being venture investments and various other private investments. And I run a pool of capital there that focuses on software and services companies, and it's a pretty concentrated portfolio. I have anywhere from 15 to 30 longs at any given point in time, and 0 to 30 shorts, all with very, very deep research on the individual companies. We're very, very highly specialized in this space.
Great. Nargis, are you on? You want to give a quick intro?
Yes, thank you. Thanks for having me, and hello to everybody. I can't start my video, Joe. Sorry. I'm having technical issues, but anyway, we are a multifamily office and broker-dealer, all in one, out of Tysons, Virginia. And we offer bespoke solutions, custom for our families. We're very opportunistic in our investment approach. I would say we tend to be more on the conservative side. We partners with teams who are very conservative underwriting. There's an alignment with our families, and there's strong governance. And this has been very, very useful as we're going through this these challenging times. We are probably around 85% in the private space right now, just as a tactical investment decision. So that's about it. Thank you.
Right. Thank you. And then last but not least, Eric Lindbergh.
Yeah, thanks, Joe. Hey, Eric Lindbergh, many of you have heard the intro before, so I'll keep it short. Original career from which I'm retired. I was in private equity at the last 15 years, partner of a couple of large private equity firms managing, $10-15 billion in equity investing into the consumer space. I'm largely extracted from that, and today spend a lot of my time in philanthropy. Sort of 50% of my time is managing capital for our family-related foundation. We have about $250 million under management. It's all for philanthropic purposes. That is a highly discretionary pool of capital, and we're able to really use it across all asset classes. We have exposure in sort of every category that you could think of. And I guess the only thing that I would say that is that is a little bit unique and noteworthy is we have an unbelievably long return threshold in that we really are seeking maximum returns for 20 plus years for the entire pool of capital because it's for the benefit of a very long-term philanthropic purpose, and so get to make some very long horizon investment decisions with what we do with that as a result.
Got it. Thank you. So why don't we just kind of kick off the conversation? We'll just kind of go through that same order. But Stephen Burke, you guys have always, since 1971, employed a more high conviction approach. But I'd be curious to understand why everyone on the panel kind of believes that right now, in this kind of post-COVID environment, high conviction is a better strategy, and kind of how you're utilizing that as a tool in your portfolios.
Well, I think it's generally I'm not in the active or passive. I'm more of a active and passive person. I think for a lot of portfolios, having the mix makes sense. And I think you just shift the weightings between the two. But for us, why high conviction makes sense generally is there are usually only a few names driving the market returns, and having a good sense, if you're combining, for us, the secular themes with bottom-up research, and you bring those two together and you tend to be away from the market, you're going to get higher returns. You'll be out of step with returns in shorter periods, but over the long term, the secular themes do play out, and that's where the best opportunities are. I think what we're seeing with COVID, though, is a destruction of large segments of the economy for temporary impairment for some and more permanent impairment for others. And the environment is creating much more positive tailwinds for a narrower group of securities. So I think it's a question of time frames and opportunity sets. Right now, it's more apparent because of the virus how divergent the opportunities are in what is a highly bifurcated economy right now.
Okay. Thanks, Stephen. Eric Anderson?
Yeah, I mean, I agree with everything Stephen just said. So if I can just maybe extend it to EM. I mean, to give some context for EM, I might be stating the obvious here, but most of the EM strategies in our peer group generally track the EM EM strategies track the EM index. So, which is, for instance, the MSCI EM index being the largest one. And the problem with the EM indices in EM is that they're a poor reflection of really the key themes and the convictions you want in emerging markets, right? These better known companies are, tend to be SOEs or global multinationals where EM exposure is secondary. A lot of them are expensive, crowded trades. So if you want to get more out of your EM, inevitably you have to shift away from the index, be more high conviction yourself. And one of the things that I always point out in EM, we've got great businesses and great opportunity to be high conviction. I have a slide there that shows a table of the balance sheet of emerging markets. That's it, bottom right. Here's the sort of top 100 corporates listed in each region, ex financials. And if you look at the number of companies with a net cash balance sheet, China, Hong Kong, Taiwan, nearly 50% of the companies have net cash on the balance sheet. So again, strong companies. And in a post-COVID environment, a lot of those companies are going to be positioned to consolidate, gain market share. And I've sort of added a few developed countries there. But yeah, so it is a fascinating asset class where you have to differentiate given the nature of the indices and the nature of the large caps. And I'll talk about the concentration maybe a bit later on this slide here. But that's how we do it, and that's how you do it in EM.
Thanks. Andrew, it sounds like you guys are more picking up, investing in managers who are employing more of a concentrated approach, and you kind of covered a little bit, but do you want to add anything?
Yeah, sure. I mean, one of the things that's very clear, there's a lot of things that are very clear. One is that company guidance is extremely difficult right now. That you're not getting the communication that you used to be able to get from the C-suite because simply they don't have the visibility. So when you've got so many sectors and so many companies that lack visibility, and when you have capital that is all of a sudden scarce, you really need to concentrate your bets on those where your visibility is higher and where the cost of capital or the access to capital is much lower. And so that is what's created in a lot of ways the return dispersion that we're trying to take advantage of by being more concentrated. I was comparing I was looking back on we have a weekly investment sort of summary that we prepare, and I was comparing yesterday's to May 18th, 2019, and it was amazing to see how the sectors, the industries, the differentiation has really blown out over the last year. To give you guys an idea, the gap a year ago on a year-to-date basis between large cap growth and large cap value was 4.4%. That was the return differential between those two segments of the market. Yesterday it was 21%. So you have it's a 5-time increase or 5-factor increase in the dispersion of returns between the large cap growth and large cap value. And obviously that's being driven by a lot of what Stephen's shown on his slides. And if you look at the number 1 to number 10 sectors within the S&P 500, a year ago, the dispersion or the difference in returns on a year-to-date basis was 17.3%. Yesterday, it was 39.3%. So there is that access to capital, even though rates are basically zero, has gotten so much more competitive that you need to be with companies that are growing, which aren't that many. There need to be companies with visibility into their growth, which there simply aren't that many. So you need to be more selective, not just to make more money, but to preserve the capital that your families and your endowments, et cetera, have entrusted with you. So.
Great, thanks. Sam?
I think that from a bottoms up standpoint, this is obviously one of the most treacherous market environments in history. So if you're not concentrated and you don't understand the underlying positions well, how can you possibly effectively triage the portfolio? How can you possibly eliminate weak spots? And then, how do you take advantage of dislocations, right? Like over the course of the past couple of months, there have been unbelievable dislocations. And if you don't know the names and you don't know the economics, how do you think about that? How do you not get whipped around by the tremendous volatility that we've all seen? And then there are obviously massively accelerating advantages to the current winners, right? But how do you think through who those winners really are and how much to pay? It's very easy to just buy Zoom at 50 times revenue, but that may not ultimately be a great investment strategy. And how do you identify some of the non-obvious winners, which is where I think the bulk of the excess return will come from in the next couple of years? So I think that there are really enormous advantages to being concentrated and focused in this environment.
Great. Yeah, good point. Nargis, it sounds like you're largely out of the public equity space at the moment from a tactical decision, but I guess how are you utilizing concentration even then within your privates book, or kind of maybe walk through that?
Right. So we have always been more into the private space. However, back in February, one of our managers, which is a merchant cash advance investment, started seeing issues with the merchants, and the merchants were not there. They were starting to default on their payments, and a lot of them had been impacted by the COVID virus back in already. They were impacted by the supply chain back in February. So we took advantage of that, and we actually got out of the public market at that point, which we always thought was with frothy valuations anyway. And we started buying once the market was down 30%. And we went into just passive ETF strategy then. So at that point in time, I was happy to kind of be a bottom fisher with just regular ETFs. I would say that's harder to do now, and now it's time to look for more higher conviction managers to help. So shifting a little bit there to the more active management. Still staying away from hedge funds, staying away definitely from the long shorts. And then on the private side, really focused on private credit. And you can pick up a lot of distressed private credit right now, but anything with liquid and cash flowing, I think cash is king. And I think it's, when I'm looking at the public individual names as well, I'm very focused on the amount of cash they have on the balance sheets.
Okay, great. Eric?
Yeah, I mean, so to maybe stir up some specific follow-ups from other folks on the panel, and to throw a couple of ideas out, and I'll just very quickly say, what we're up to in general. I mentioned that we have a very long-term investment horizon for returns with our philanthropic capital, and so we actually don't engage generally in market timing and as strategies. I also have been for 25, 30 years extremely skeptical. It isn't about this time period where we have dislocation and distress. I am always extremely skeptical of all forms of public equity stock picking, and we don't need to go into the background. Everyone will know what the argument is going to be, which is that when you look very broadly, very few managers are able to demonstrate a consistent ability on a net cost adjusted basis to just beat indexes. And there's a bunch of technical reasons we can argue as to why, but the reality is very few people have the ability to be looking at dozens and hundreds of names and knowing something special and differentiated that allows them to have alpha in the way that they select investments. Like I absolutely do not believe there is data that supports that in the longer term. I'm interested in folks that that want to counter argue that it is possible to simply be better than everybody else in a highly efficient market in the public space. So my high conviction is that I generally avoid having convictions in the public space. I will say, though, that it is smart to, and I follow kind of, it's almost, it's very old school. It's sort of like a Peter Lynch and Warren Buffett mentality of, when other folks are clearly much, around financial management are a lot smarter than I am. Like, I think I can be smart about a handful of things, maximum, maybe. And so I wait really selectively for places where we want to place big bets based on some somewhat proprietary insight. I skew towards the private side in making those assessments, because I've 25 years of experience in the private equity space of managing capital and seeing everything that happens around that space. I am highly confident of my ability to render good judgment on managers in that space. We have a hedge fund strategy. I don't know a damn thing about hedge funds based on my personal experience. And I'm not going to know something about hedge funds based on some advisors, giving me some pitch books and presentations about how hedge funds work. We actually have therefore a very, very quantitatively defined hedge fund strategy that is very specific and looks for a very, very narrow type of manager that is non-correlated with public market indexes. And it's an entirely quant strategy that we use in hedge funds. I will say, and then folks that have heard me over the last month and a half say that I have seen a huge disconnect between underlying data about the virus crisis and what people seem to perceive and be saying about it. I made an exception. I guess I just lied 3 minutes ago and said I never believe in market timing. Starting on March 13th, I began an extremely aggressive buying program on U.S. call options on indexes, because what I saw was a level of fear and panic that rose to the level of irrationality. We've now exited those positions, but after making 2.5x capital deployed in a 4 to 6 week period, because I became convinced that the market had honestly gone crazy and it was time to bet against people who were running around in a panic. So I think, Joe, I'll sort of close out, with this maybe a question within high conviction for everyone here believes in it. How many names, how many ideas, how much high conviction can you have, and how many good ideas can you have at one time? My argument would be like, hey, single digits is what I'm capable of understanding on a differentiated basis. If you're talking about trying to have high conviction in the ability to generate alpha and above average returns across dozens of different decisions, I'm really curious as to how people do that.
Gotta love Eric, man. Thank you for stirring up the pot on these panels. It's great. That kind of will drive us into maybe this kind of active versus passive kind of conversation, and maybe to the investors on the panel. Why are you guys worth your weight in fees, and kind of, how are you able to kind of add alpha, and how have you done that? So maybe, I don't know, Stephen, do you want to kind of kick us off? I know you kind of mentioned that you guys have a very long track record. In addition to, you guys use active and passive strategies, but maybe do you want to kind of respond to Eric, and then we'll have Eric Anderson, and then maybe Sam kind of go through that as well.
Well, the interesting thing about the industry as it's evolved is before indexing really took off in the mid 80s to late 80s. I was at Dreyfus, and I started an index fund at Dreyfus to chase Vanguard, which is what firms in the asset management business do. They copy and then they try and chase. I just think we had too many managers in the industry, and most of them weren't prepared to manage money for clients effectively. I think there were just too many people. So the numbers skewed towards, the percentage of managers that underperform is quite high. I think that that at any point in time, there are certain managers that would never have a shot at outperforming because they don't have the capabilities or the investment approach that allows them to do it. Most people were just really closet indexers in the industry for the longest period of time. It's actually what chased me out of the big asset managers, is they were not really trying to have a point of view or actively manage strategies. I think they were closet indexers. So I think the numbers justify what Eric said. Although I think that we actually have an industry that's getting smaller in terms of the number of managers, and the firms are consolidating. And I think that actually will contribute to a return to a better understanding of, can people actually outperform? I think where you get performance is taking a longer term view and to have a perspective on it. We actually move up and down the market cap structure, and as you know, Eric, that it gets much less efficient the lower you go down in cap structure. So being an all cap manager, we're able to combine the best of large cap names when large cap makes sense, and smaller cap names that you get some higher growth typically, and that's where you move away. And I think the view of being active, I think most managers weren't active. I think they were really not actively managing anything other than trying to stay in the job for a longer period of time. So I think there are opportunities to do it. I think the numbers you can't argue with, but I think if you understand behind the numbers, there were just too many people in the business, and we've seen that in every area of our business. When hedge funds were outperforming public markets, it's because there are a few people chasing a smaller number of opportunities, and that went away when everyone chased the same thing. And now in the private equity space, the last bit of time, you've seen everyone chasing private equity, and the opportunity to add value diminishes that way too. So I think it's the law of numbers. But for us, we think having a macro view and combining it with bottom-up research and keeping the number of names down. The biggest portfolio we have in terms of number of names is about 35. We have a small cap strategy that is under 20. We have our all cap has under 30. And we have a focused ETF strategy that uses 8 ETFs. A lot of them are industry ETFs, not sector ETFs. So there are ways that you can work around that. But for us, it's very much about knowing who we are and how we operate, and knowing what the other people are doing and not caring. We just really try and take our own point of view to it, and it's worked for, we've outperformed since '93 by a pretty healthy margin net of fees. So we're comfortable with that, but you have to be comfortable being out of step too, and that means you need clients who are comfortable being out of step, and that's not as easy to find.
Mm-hmm.
Got it. Thank you. Eric Anderson, you want to weigh in?
Yeah, I mean, EM is a lot easier to grasp in terms of inefficiencies, right? So it is much less efficient in terms of information getting to the markets. You've got barriers to entry. I wrote down a few here: language, travel, not being on the ground, which is the way we set up our EM product the way we did, despite people saying multi-specialist strategies never work and it's an extra layer. I said, forget that. Think about it in terms of, what do you want exposure to? You want these strong companies down the market cap spectrum, small caps, mid caps. You're not going to find them sitting in New York or London necessarily. You're going to find them by being in Mumbai, in Shanghai, etc. So in terms of barriers to entry and efficiencies, I think EM is certainly a place where where active management makes a lot of sense. If I can just point you to one of the slides, one of the things about EM, it's quite almost counterintuitive. We get new, that's it, that's the one. We've had Saudi Arabia, Argentina, we've had new entrants come in, right, into the EM index. It's constantly evolving, but, counterintuitively, it's getting more concentrated. I'm looking here at bottom right, you got top 3 countries, 65%, top 2 sectors, 50%, top 4 stocks, 20%, and this is, and so you look at that and you're thinking, well, that's, there's a very few handful of stocks, sectors, and countries that are driving performance. And if you look elsewhere, over 1,200 stocks in the index, so this is MSCI EM index, have less than 0.5% weight. I mean, so the opportunity is there. And if you look at our portfolio, and we're not contrarian, we're picking strong companies, high quality businesses. None of our top 10 stocks are overlap with the index, and you won't find that anywhere else. We don't hold Alibaba, we don't hold Tencent, we don't hold a lot of these stocks that maybe everyone else holds. But why? Not because we don't like those companies, but because we're finding better companies elsewhere. Property management services in China is a booming sector. We're up 70% this year in that sector, and other sectors as well I can talk about. But certainly there are some advantages. We think active is the way to do it.
Great. Sam?
I think that I agree with Eric that it's really not possible to have high conviction in a large number of names. I think that the markets, especially over the past decade, the public markets have changed considerably, and it's just a lot more difficult to have any kind of real informational edge. That's a fact. That said, I think that there is a lot of value to be added in public markets. I think public markets are a function of pattern recognition. You have to be able to make bets when the odds are in your favor. How do you make that determination? You have to have some kind of deep context to be able to make decisions in a better way than your peers. Every day that you hold a stock, you're making an active decision to hold it or sell it. And I think, to the extent that you have that deep context and you have a systematic process for making good decisions that is data driven, that somehow mitigates, you can certainly produce a significant amount of alpha. Everyone can't produce alpha, obviously, but there are always going to be many, many funds that do produce alpha. And I think the market is, in fact, a very inefficient place, right? Like the volatility of the past couple of months, I think is the greatest evidence of that, right? The great thing about public markets relative to private markets is that things are marked to market every day. There's always volatility and always opportunities to make decisions where other people are making the opposite decision. And if you can do that effectively, I think there's just there's a lot of value.
Great. Andrew, I don't know if you want to weigh in. I'm just giving you the optionality here, but no pressure.
Yeah, no, I mean, there's a bunch of themes and topics that people have touched on. One is I see a lot of comments on the chat about small cap, and is small cap, what are people doing in the small cap space? We were overweight small cap last year based on valuation. We had invested with two new managers who were highly concentrated. One was the dividend growth manager, which is probably the worst place to be in any segment of the market because dividends across the board are being questioned. And that really hasn't come back as fast as other things have. But if you look on the small cap space, on an earnings basis, they've basically, the consensus forward estimates, which I'm looking at right here, you're going back to 2013, 2012 levels of operating earnings per share. So 8 years gone. But when you look on the margins basis, which I was just had on my screen, you're back, the S&P 600, which is the reference we're looking at here, expected margins are actually even below 2009 trough levels. So the expectations for small cap are catastrophic at this point in time. And right now, even though I haven't lightened up on those bets because we made that bed and we're sleeping in it and we have capital allocated to very good companies, I'd be hesitant to add to small cap if I didn't have a high conviction view on the state of the economic or the path of economic recovery, particularly in the United States. It is so tightly wound together with the labor market, retail sales, et cetera, that small cap is a treacherous place, and you have to be with a very high conviction people who are worrying about balance sheet risk at the end of the day.
Great. Why don't we take some time now, maybe and kind of express, how you guys are getting concentrated. And if you want to spend some time talking about either sectors or themes, that's fine. But also if you want to talk about specific names that you really like or are a fan of, please, you're at your discretion. Maybe Stephen walk through, I know you kind of walked through on a high level some of those sectors that you guys liked, but let's kind of get into it, where you guys are positioning the portfolio, and then also how do you risk manage that portfolio when you are taking that concentration risk?
Well, let's start with the risk part, because risk means a lot of different things to different people. And it really depends. Like, Eric's, if you could find a bunch of investors who had a multi-decade view of risk like Eric might have, that's rare in our industry. But it matters how you think about risk based on that. Is risk underperforming the index, or is risk doing what you're trying to do and thinking about the risk of the businesses or the earnings and the like. So we look at risk on multiple levels. We think about risk from our macro views being wrong, and what's the probability of that, and what's the impact if they are. We think about the risk to the individual portfolio's earnings, And then we think about the risk for the overall portfolio relative to the guidelines that were provided by the clients. And we have to combine all those, and we're constantly probability weighting. So for us, it's really about the risk of being wrong on the outlook and on the earnings power of the companies, particularly in an environment where growth is so scarce and you're trying to bet on companies achieving above market growth to generate the returns. And you're seeing that with the extremes that Andrew was just highlighting in the small cap area. And the only way companies are going to meet expectations is that their earnings grow back into their multiples, because the multiples have run away given the drop in earnings. So it really for us is about determining the difference between earnings and earnings power, and understanding who can earn what you think they're going to earn versus what their reported earnings are in the short term. I guess the themes you guys have heard us talk about for a while. So I just think that when we think about the thematic element, we're looking at over the next couple of years, and we're differentiating between trading and investing, and neither is it, that's not a pejorative for either one. It's just that you have different expectations, whether you're looking out over a longer term or trying to trade a market. And we tend to avoid trading the market. What we do is we hold higher levels of cash to deal with volatility and take advantage of it. So I think that's the key elements for us in thinking about risk and managing it. And even right now, we're probably at 12% cash in almost across the board in our firm. And we've been that way for about between 8 and 15 for a better part of the last 3 years, because the volatility is giving you great opportunities to pick up stuff on the cheap because of the swings that we've had. So,
Eric?
Yeah, I mean, we look at risk. Well, there's two components, right? So the bottom-up stock picking, and the way we address it is we only buy stocks that companies that we know. So knowledge, that's how we address it. The turnover of our team is under 20%. So we're active, but we buy and hold the strong companies that we know about. I mean, from a top down, the asset allocation side, I mean, if there's anything, this is the mother of all stress tests this year, right? Warren Buffett said, someone mentioned Warren Buffett earlier, I'll quote him again, saying, when the tide goes out, you see you still wearing a bathing suit, and who isn't? And we've seen it. I mean, on the country level, I mean, it's just phenomenal. See the countries that have, that are managing their, managing their countries well, and those that aren't, the good health systems, the ones that don't have good health systems, et cetera, both in the company and country and corporate level. So this has been a great exercise to shake out, who hasn't been properly investing in high quality companies who said they were, who hasn't been looking at maybe some of the macro views. So it's been a great, and we have been doing that. And so, so performance has reflected the sort of our work behind that. So, and so in terms of some of the sectors that I want to talk, I mentioned the property management services sector, and I want to talk about that one again, because I think, we have 30% of our book is in that sector. It's a, very domestic focused sector, mainly in China, high visibility on earnings. One of the, you can't say that about most sectors and companies these days, but this is a sector that has been less impacted or not impacted by the coronavirus. Property management services companies are companies that come in and do the gardening, the repair, they manage the tenant. They don't own the land, so there's no overhead. They just do the maintenance. So it's a stable, reoccurring revenue stream. And we own about 5 companies in that sector. And it's very fragmented as well. Another area we like to see fragmented areas allow for consolidation, picking the right winners, because we feel that we can do that. So that's a sector we like a lot. Another sector we like a lot is online education. And we know about this. Those who have kids have sort of painfully dealt with shifting to more digital channels. And that's the reality. Probably today, University of Cambridge here in London said that all of next year is all online for that's the university level. But even coming down to primary school, that's touch and go whether they come back to school. So we're investing in some really high quality businesses in Brazil who have a great platform for education. So I think that's a really interesting sector. But you got to pick back the winners there, because there is a lot of different companies. So that's what I'll say from that side.
Great. Andrew or Sam, sorry. Go ahead, Andrew.
Yeah, I wanted to pick up on a question that Simon just chatted, which is an excellent one about following the large cap companies, sort of the leaders of the market now, and then stepping into other tiers of the market later on. That's exactly what we're expecting to happen. Growth is going to be very hard to come by in any industry, x the obvious ones that everybody's already probably invested in. So you'll probably have a significant overshooting in that area, particularly over the next, we'll call it 3 to 4 months. We don't expect that to change anytime soon. But at some point, the winners of the losers will start to appear. And that is, and I don't remember if somebody made a comment, I don't remember who it was, I think it was Sam, that that part of the market will be where the outsized returns come from in this next phase, is which are those winners of those losers. And I think it's still a little early, but it's not early to start looking for them, that's for sure.
Sam?
Hey, sorry, I'm a Zoom rookie, and I keep having trouble finding the unmute button. I was on the chat. Yeah, so first off, from a bottom-up standpoint, we spent a lot of time in the first few weeks of the crisis really triaging the book to understand what may have changed with respect to our baseline understanding of the companies, right? Like, there were lots of previously very solid companies that might have had their medium-term growth curve bent by the fact that, they have some segment that's 20 or 30% of the business that has like zero revenue for 2 months, or an 80% decline in revenue. And, do you have to let go of salespeople? Do you have to do things that otherwise hamper, your intermediate and potentially long-term trajectory? And by long-term, I say, 5 years, right? And then, how do you think about dealing with those situations, right? Like, what's the likelihood that it's going to come back? How much flexibility does the company have, et cetera? Are they generally shareholder friendly? How do they think about raising equity? We spent like a lot of time, really working through the portfolio to understand whether the underlying earnings power had changed, right? Because I think this is like a really significant event that no management team has ever seen, right? Like, what company is prepared for an 80% decline in revenue, right? And then, if you think about the universe in which I operate, there are a lot of potential winners, right? Like application software companies. Many of these companies have had their growth pulled forward by 5 years, right? Because companies that specialize in digital commerce, digital customer interactions, these are all things that people need in the new world. And they're, more obscure things like, companies that sell banking applications to community banks, where previously, nobody would have ever made a commercial loan without shaking someone's hand and looking them in the eye. Now they need an application to be able to do that virtually, because maybe they can't do the in-person business going forward. And there's like a lot of stuff like that out there, but it requires very detailed thinking about the go-to-market, right? Like, how do you actually sell to these people? Can you do inside sales, or do you need to do long implementations in the field, which might be delayed? Is the product really strategic to customers, or is it something that was strategic 6 months ago and might be put on the back burner as CIOs look to cut costs because companies are struggling with revenue, right? There's like a lot of interplay of cross currents that need to be effectively managed in this environment that, I don't think anybody has had to do previously, even in 08, right? So it's been a very interesting process, but one filled with I think lots of opportunity.
Okay, great. Eric, any other kind of comments or thoughts right now?
And that's to me, Joe.
Yeah.
Yeah.
Sorry.
So I mean, look, I really value this conversation. There's, I'm not gonna flatter everyone who said things that are super smart. There have been a lot of, I think, really good observations here. And I think Stephen, you made a point that I will powerfully echo, and many of you guys have, and this is based on very in-depth career exposure to this. I started working in the private equity space in 1994 at Blackstone in the mid 90s, and then saw as a junior guy, like, deal making across a number of these firms in the 90s, the early 2000s. And I also saw private equity deal making in 2016 in the same space. And I wouldn't even call it an evolution, because it was more radical than that. The nature of finding alpha, of finding the ability to create really attractive equity returns when you have six competitors, right? Sort of the supply demand dynamics of, there's six people with $500 million under management in private equity in 1994, and the different environment when there are now thousands of Yahoos, everyone and their brother now has $1 billion fund bidding, right? Like that sounds, people know theoretically what happens. Like I saw what happened. That industry in multiple categories within alternatives management have been wildly transformed in a 10, 15, 20-year period. The one thing that I think is a little bit interesting, and that I would say everyone should always, through their life and their career, should have like their antenna and their radar set on 100% to monitor, is there is kind of a boiling frog dynamic that all of us have a hard time doing, which is realizing how all of these individual categories, and when you're talking about, you're talking about emerging markets, or you're talking about mezz investing, you're talking about the early days of hedge funds, all these different categories, there is a heyday when there's a small number of participants and it's a really cool, risky new area, and everyone is cranking out 15 and 20 and 25% IRRs in their deals because there's no other capital and there's no other people competing with you. It's really, really difficult for any of us to have like the acute attention to see how all of these sectors change and they become less desirable as a bunch of people get sort of drawn in, and now you have 500, not 5 people in any of these categories, and it's been exactly the same trend across every of these individual every one of these individual little spaces. And it brings me back to kind of a point I had from the beginning, which is one, having very, very narrow focus, and the ability to have that conviction, but also being nimble in knowing when it's time to move on and move away from a category. Like, I can't tell you how much less fun it was to be doing private equity transactions in 2015 as opposed to 1995, but it applies across all of these different spaces. I think it creates, I think, a challenge of figuring out, like, hey, maybe it's time, and we were talking at the beginning of this, of finding the ability to create a lot of value in the cannabis space. That's obviously a very disorganized space without very many sophisticated participants. That's a place that you're going to see above average equity returns for a lot of investors. Sam, you also made a comment about being very, I think, analytical and patient, and I almost thought you were going to tell us that you were describing a card counting strategy and how to beat the house. But that level of like patience and analytics, I think, also drives the ability for some people to consistently be able to to beat the market by actually taking that little bit of a longer term, disciplined, analytical view and being very judicious about where you're focused.
If I could just, Andrew here, add a little point to I've heard the expression alpha, beat the market, outperformance quite a lot, which is what we want from all of our portfolios, all of our companies, all of our managers, depending on how you achieve that. But at the end of the day, it's important not to lose sight of the fact that there's an investment objective, which is generally driven by a family's idiosyncratic needs and desires, and being too focused on alpha beating, outperforming, you can lose sight of that investment objective, and also lose sight of the fact that that asset class, or this asset class that we're talking about, public equities and really large cap public equities, which has been the dominant theme here, is one element of an investment program that is designed to achieve that objective. So sometimes I'm perfectly happy underperforming if I know that what I'm doing in that underperformance with that manager is wholly consistent with the overall investment objective and the investment strategy we have for the family. So I think that's something not to lose sight of.
If I could just add, Andrew, that's a great point. The other thing is the role of liquidity in the portfolio changes as market conditions change. And for a while, nobody cared about liquidity, and you never care about it until you care about it. And it's usually too late. And so I think the idea of a well-designed portfolio allows you to get through a lot of the sins that occur inside timing and other issues that naturally go on in our markets, particularly when the structure of the markets have changed so much. You know, the Wilshire 5000 started with 5,000 companies, peaked at about 7,500 companies, and is now down below 3,500 companies in that index. So we've gone through big shifts. The average holding period dropped from like 8 years in the 60s to, you know, just under 3 years in 1980 to now it's seconds, depending on if you're looking at high frequency traders or regular investors, you know, typical long investors. So there's so much different dynamics going on in the markets that you actually have to be able to either sort out, or you're looking for short term, or you're going to manage to a reasonable time horizon. And all these factors are really shifting, which makes it hard for allocators to determine. But it starts with having a great foundation for your allocation. And it has that's the one thing that really hasn't changed throughout the whole time.
Thank you. And we just said, so let's just kind of want to open it up for more general questions. I saw in the chat, Tom Jump just asked a question, kind of more talking about, you know, how will and when will the upcoming election really begin to influence how investors are looking at public markets? As you know, over the most recent past, COVID-19 has really driven much of that sentiment. But you know, when is the kind of election going to really weigh in on people's views of the public markets? And then from there, let's just kind of open it up to questions, Q&A, just generally.
Well, I can quickly make a comment on China-U.S. relationships in relation to the election. You know, I think you know, we have 40 years now of China and the U.S. sort of coexisting, right? Even though they have, you know, their different sort of ideology, they've sort of put that aside and agreed, listen, for economic case, let's cooperate, right? So, but that is coming a little bit to you know, to an end now. There's been more confrontation lately, and I think regardless of who wins the election in November, Biden or Trump, because I don't think this is a Trump thing, the confrontation will stay the same. I think the U.S. has embarked on that route, and there will continue to be confrontation. Now, I'm gonna stop there and say, but it's not a new Cold War, right? This is not like it was previously. The reason why is during the actual Cold War, actually, there was a sense of, you know, coordination between the, you know, political establishment, business establishment, and cultural establishment, right? Everyone was coordinated. But today, that's not the case. The political establishment, business establishment are not on the same page. You know, you don't just unwind, you know, global supply chains. You've got, you know, semiconductor businesses in the U.S., industries in the U.S. that are relying on Chinese demand. So a lot of that, you know, the decoupling will not happen because business interests and establishment will prevent that from happening. So that will stay the same. But there will be this confrontation going forward, regardless of the election. So just to add a bit of EM flavor to that question.
Yeah, I think one of the questions, if I could just touch on it a little bit, is that I think regardless of who wins, they're gonna have a really difficult time raising taxes given the economic backdrop that we're facing. If the Democrats swept even, they could take away some of the things that gnaw at them, like carried interest and other things like that, and close some loopholes. But across the board tax increases are going to be very difficult in the in the near term, and would be actually a ticket to getting thrown out of office at the earliest chance possible, given what I think the economy can withstand in the next 2 or 3 years. And then it gets to the other issue, which is how long, is the reversal of technology and healthcare, which had big bullseyes on them from a lot of the Democratic candidates running, has that changed given what the virus has done? I think there's still going to be a lot of pressures. I just think the math of the country doesn't work right now, and we need a complete reset, which I don't think either party is capable of doing, unfortunately. And we probably need a new next greatest generation to deal with the problems that we're dumping on our kids. But I think it's going to be a problem that we're going to have to kick the can down the road again on dealing with some of the real issues. And I don't think it matters who's in office as much, unless there is a bigger swing than I'm expecting to the far left.